Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostic.
And I'm Scarlett Fu. And when we look at the markets, there's not a whole lot going on at the headline level for the S&P 500. But for the week, you look at treasuries, you look at munis. At one point, munis were on track for their worst week in 2024.
Yeah, I mean, it's still there. Last time I checked, it was going to be the worst week since at least April here. And it gets to this idea of why we're seeing certain things being sold off and other things being bought here. And particularly in the muni space, because you would think that this would, given some of the skittishness in the market, you'd think you would see a little bit more activity there in the secondary.
Well, they're basically following treasuries lower at this point, and yields higher as the economy here in the U.S. doesn't appear to need as many rate cuts as a lot of people had hoped for earlier, and that has kind of caused a rethink, a repricing across the fixed income space.
And if you're an optimist, that's actually a good thing because it means the economy's holding up, soft landing, but everyone just wants more rate cuts more now.
Yeah, well, Barclays and JP Morgan are saying now is a good time to consider buying munis, considering the strong market technicals, especially in November and later on this year.
Yeah, absolutely.
All right, so let's talk about where things stand with 11 days to go before Election Day in the U.S. Experts are going over the candidates' tax policies with a pretty fine-tooth comb. Morgan Stanley says that regardless of the outcome, it expects deficit expansion in 2026, though investors are tilting toward higher deficits in a GOP sweep scenario. And when it comes to munis, since we're talking about munis, Morgan Stanley says fiscal expansion won't bring back pre-refunded bonds, but could drive a bear steeper in a way that is ultimately negative for muni excess returns. So as part of our muni moment, we want to welcome Michael Zezas, Managing Director and Head of U.S. Public Policy Research at Morgan Stanley. Michael, good to see you.
Yeah, thanks for having me.
So let's just zoom back a little bit here and talk a little bit about the candidates' tax policies, because on the whole, they're promising a lot of things to potential constituents. What are the tax plans right now? Because I think about what President Trump has promised, and he's promised no taxes on tips or no taxes on expat earnings. It seems like every group gets no taxes.
Paychecks,
exactly.
Well, I mean, broad brushstrokes, okay. Republicans want to limit taxes as much as possible. The main conduit here is the set of expiring tax cuts from the TCJA that expire at the end of 2025.
And that's only the individual taxes that expire, right?
And there's a number of corporate provisions. So the corporate rate wouldn't change if left unchecked, but there are a number of provisions about deductibility that wouldn't extend. And so the Republican plan has been, let's extend everything. And on top of that, Trump has talked about let's not necessarily extend some of the things that would help pay for that. So the implied deficit expansion looks quite large, right? But there's a difference between what you say you can do and what you could get done. Even in a situation where Republicans sweep, we expect that the kind of headline number of extending everything for 10 years, the stuff that like the CBO talks about, that's like $4 or $5 trillion over 10 years, would probably be too big of a number to swallow. You might end up with a kind of shorter term extension of a number of those things. But still, even if you get that number down to like $2 trillion, you're talking about in 2026 a deficit expansion year over year that might be like $300 or $400 billion in that scenario.
And what about the Democrats' proposal?
Yeah, I mean, the main difference with the Democrats' proposal is that they're talking about bringing some revenue to the table, right? So they would only extend about half of those expiring provisions. They'd also like to introduce a new amount of spending, which is an increased child tax credit, but offset it by taking the corporate rate up and a couple of other provisions up. That to us would net out to something maybe like $600 or $700 billion spread over 10 years, but still in that first year, it's still like $200 or $300 billion. So it's still an increase in the deficit, but to a lesser amount. That would probably, though, require a full sweep by the Democrats, and if the prediction markets are to be believed, that's looking like the smallest possibility amongst all of them.
I mean, how are you guys gaming it out, you and your team over there, particularly when we get to November 5th? I mean, there's the expectations we won't probably know the full results of the election on that night, and it may actually take a few days here. So how are you preparing for that, and what are the kind of the key things that you're going to be keeping an eye on to determine how the race is going to shake out?
I mean, I don't think we have a magic wand or anything. I mean, we're trying to develop situational awareness like everyone else. If the polls are even close to right, this should be a very, very close election that's going to boil down to a handful of states and probably a handful of counties within those states. So we're going to be doing the same thing everyone else is, which is like really tracking vote counts carefully and seeing where they point to develop situational awareness. I don't know if there are specific trades to do in that kind of let's say if we follow the 2020 timeline, you more or less know what's happening by the end of the week, so call it the 72 hours. So we're not going to be really focused on telling clients do this or do that in those 72 hours, but expect volatility as the markets are trying to sort out what's happening and what the forward policy path is.
Is the market trade too lopsided, though? I mean, so I created two separate baskets. One, the Trump trade stocks, and one, the Harris trade stocks, or whatever you want to call it here. The Trump trade stocks clearly outperformed over the last week and a half here. This is a little bit different setup than what we saw during his race in 2016, where he won as a surprise to a lot of folks who, of course, woke up the next morning and realized they were on the wrong side of that trade.
Yeah, I think you are starting to see some of these softer market indicators kind of hinting that perhaps there's some higher faith in the idea that Trump could win. I don't know if that means they're pricing in a greater than 50% probability or not, but you're seeing it in the stock market. I think you're seeing it a little bit in the steepness of the yield curve. But to your point, in 2016, even though the polls would have suggested going into it that Trump had a pretty good chance of winning, it still struck as a massive surprise. I don't think it would strike as a massive surprise this time around.
I'm curious what you're going to be doing on election night. How are you going to be looking at what's going on, and what security or asset class do you think will start to move the most, or could move the most, based on the early results?
Well, I mean, we'll be tracking results like everyone else, and I think the markets that would be particularly attuned to different outcomes would be the Treasury market shape of the curve in particular. Not that we necessarily agree, but I think what most clients are tracking is the idea that the better Republicans do, the steeper the yield curve might be, because you have to kind of balance out the idea that Republicans in the White House might mean more tariffs and kind of growth pressure in the short term, with potentially kind of longer term deficit expansion either being good for growth or wider deficits and more term premia. So that's something we'll be tracking. We'll be tracking currencies in particular. Discussions of tariff on Mexico, for example. Dollar-peso pair has historically been quite sensitive to perceptions of the outcome. That's another indicator to look at.
Would you start looking at chip makers, or any of the companies that are affected by Chinese tariffs, for instance, or tariffs on China? Excuse me.
Yeah, I mean, potentially. I think that one's a little harder to kind of disaggregate from the macro environment. But like clean tech stocks, in theory, might be pretty sensitive to different outcomes, because while we don't think that, or we think the bulk of the IRA is probably in place regardless of the outcome, certainly the probability changes if Trump and Republicans do better. And those are stocks that are a little better protected because the money in the IRA is a little bit better protected if Harris wins.
All right, Michael, great stuff here. And I just want to point out, too, we're getting the latest CFTC data crossing the wire here, and now seeing speculative traders flipping to net long the dollar for the first time since August. Michael Zezas over at Morgan Stanley taking a closer look here at the potential policy implications for the market coming out of the election.